Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita. Let's quickly pull up what the Nifty is doing at this hour. And it's been a rather tepid day, 0.5% odd lower on the Nifty. But really, that's the kind of day we've seen yesterday as well as, and that's carried forward into today. Fascinating because the global handover wasn't as bad, but we've seen a bit of weakness on the Nifty, and that's carried into the Nifty mid-cap as well as into the Nifty small-cap indices as well. The breadth is obviously negative. It was positive at the start of day today. It was doing quite well, but that breadth has turned now, and you're seeing quite a bit of pressure where the breadth is concerned as well. So, of course, not looking pretty per se, but not looking particularly bad either. The Nifty Bank, one of those culprits, which is pulling down the index itself, 0.5% lower on the Nifty Banking Index. Outside of that, autos also down roughly 0.4 odd percent. Metals, which was showing phenomenal strength in the morning, is actually, the index is down 1.3%. So you're seeing pressure across the board. The Nifty PSU Banking Index also down 1.7%, a percent lower within broader markets on the Nifty Realty Index as well. So you're seeing pressure across that entire, all of those sectors. The one sector which is doing okay, if I can call it that, pretty much all sectors in the red, by the way, but one sector which is doing okay is the Nifty IT Index. That one showing some resilience, not slipping particularly badly and holding on in trade today to a certain extent. And that's thanks to the HCL Tech numbers to a certain extent as well. In fact, let us pull up some of the constituents within that IT pack. The Tech Mahindra is one of those which is holding up fairly well, 1.3% higher. And again, you have the earnings of Tech Mahindra expected post-market today. Wipro is the other one. Again, the anticipation of earnings is keeping this one also perked up, 1.4% higher. Persistent also expected to declare numbers today. Wipro, of course, not today, but Persistent and Tech Mahindra today. And both of those stocks are doing fairly well for themselves ahead of earnings. What's not doing well? TCS, which slips again below the 3,000 mark, and Oracle Financial is the other one. Coforge also seeing some bit of pressure, a percent lower on some of those names. Let's talk about the Nifty 50 now, and let's talk about some of the names which are doing well. Now, of course, I've spoken about Wipro and Techem. Those are the top two gainers on the Nifty. But you also have Max Health, the new entrant, doing well. Apollo Hospitals is doing well. So all of the defensives are actually outside of IT. The defensives are doing fairly well for themselves. ONGC is up 0.8 odd percent after they suggested that they will not allow, or that they don't anticipate oil to slip below the $60 per barrel mark. You're also seeing HCL Tech doing well for itself within that Nifty pack. So those are some of the top gainers. But when you're looking at the breadth on the Nifty, 13 advances to 37 declines. So it's quite sharp in terms of the decline. And let's talk about some of those stocks. Bajaj Finance, 2% lower. Tata Steel has had a phenomenal day. If you look at it intraday, and I'll wait for that chart to come up, look at that move. It was up nearly 2%. And now we're down nearly 2% at the day's low, is where Tata Steel is currently sitting at. Some of the other losers, BEL, Dr. Reddy's, those were some of the gainers, in fact, between yesterday and today morning. JSW Steel is the other one, 1.7% lower, and TCS, we spoke about that, 1.5% odd lower. So those are some names on the Nifty which are seeing pressure clearly and evidently so. Let's talk about some names which were newsmakers today, and within that pack you have a Tata Motors, again, even within the Nifty, but also otherwise. That one is okay. Mind you, this is, of course, post the adjustment to the Tata Motors CV stock, which is going to get separately listed. But within broader markets, it's landmark cars. Phenomenal move today. Also very strong numbers to back that move up. 9% higher, 2,200 crore in market cap. Anand Rathi is the other one, 7.5% higher. Very strong set of numbers, and therefore you're seeing that reaction on the counter. MCX is the other one. HDFC Securities hiking their target price from 9,000 to 10,000. Stock is perked up 5%, and very good momentum seen in MCX over the last few sessions as well. Cochin Shipyard is the other one, 2,000 crore order win, and you're seeing the stock up 1.5 odd percent. Utkar Small Finance Bank, on the other hand, in focus because of the rights issue going ex-date to the rights, and you're seeing the reaction on the stock as a result of that. Aptus value is the other one, a percent lower on an Aptus value. Chola Finance, though, was on Kunal's radar this morning, down 1% as well, so some bit of pressure, and that's largely in line with how the Nifty has performed, so really nothing to complain about. But Kunal, if someone, one of our viewers has bought a Chola Finance in the morning, what do you recommend he does now? Hold on, or would you suggest he books at this point of time?
So yeah, my target was closer to 1690. The stock made a high of 1675. I think at one point the stock was up 1.5 to 2% at the start. A good part about the first half an hour, first 1 hour of trading,
right.
And I think post that it's just come back to a flattish territory. I'll still suggest to hold on to that trade because the stock is still looking fairly attractive. Yes, today we've seen some pressure emerging on the banking names as well as on the overall larger cap theme, but I think Chola Finance is something which has been looking attractive, so I would suggest to hold on.
Okay, and some other names, MTAR Tech up 11%, MapMy India up 6%, and in this market, to make this kind of a move is surely something which is extremely good. You're looking at Shilpa Medicare, Avalon Tech, those are just some of the names which are languishing, 5% low on a Just Dial as well after those numbers seem to disappoint the street. A PN Gadgil is down for Dixon Tech, a Sagility. Those are just some of the names. And a Jyoti CNC. Those are some of the names which are seeing pressure. Kunal, how are you viewing markets today? What are the pockets that you are either looking at, or is there anywhere that you're buying the dip?
So not buying the dip as such, but yeah, I think there are many pockets where we're seeing some strength emerging. For example, using the NBFC pocket or the HFC names, that's where I believe Shriram Finance, I think for a good part of the trading session, was doing fairly well for itself. A few of the auto names, and both the auto as well as the traditional auto and the auto ank names, I think they're the ones which are looking attractive. So I think, for example, Bajaj Auto, that's a stock which I think at current levels looks fairly poised for a decent up move. Samvardha Motherson Sumi, that's a stock which has looked quite charged up, and the stock heading towards a breakout. And even Sonacom Star, I think that's another name which I believe is looking quite strong. The stock has confirmed a swing breakout in the daily charts. So I think on the back of this, very few stocks which are riding on high momentum, but I think as a short-term play, traders could try and look at these kind of names.
Wow, that's a very strong move on Sona BLW. I seem to have missed that, but that's a 5% move up on the stock price. So extremely strong move. Kunal, picks in this market?
So yeah, two buy calls, and the first one which I would suggest would be something I just spoke, that's Samvardha Motherson. That's a stock which is looking attractive at current levels, and my sense is that the stock is heading towards a trendline breakout, and it's a decent trendline breakout because it's been lingering around for the stock price over the last 10% of this correction. So would look out for a decent turnaround over the near term for Samvardha Motherson. Would look out for a buy with a target of 108, stop loss to be kept at 102. And the second would be upon HDFC Bank. Now, even after a muted day today, I sense that the stock is now trying to form a base at this 970.75 mark. So purely as a short term for the next couple of days, would look at 990 as a target for HDFC Bank. Stop loss to be kept at 962.
Okay, and let's slip into a short break with that. Those are picks coming in from Kunal. Maybe not something which needs to be looked at absolutely today, but which could be squared off at a later point. So keep those on your radar. We'll slip into a very short break. On the other side, we'll continue to talk stocks. Stay with us here on ET Now. Thanks for staying with us. And amid this trade volatility, where should investors park their money? Let's listen in to what market veteran Prashant Jain's strategy is, the stocks and sectors he is keeping on his radar. Listen in to the slice of the conversation that I had with him.
Warren Buffett has said that equities are a device that transfer wealth from the impatient to the patient. So the only thing you need in equities apart from decent understanding is loads and loads of patience. And when I started my career, the first 10 years index delivered zero returns. Between 1992 till 2003, the index returns were zero. But the subsequent 5 years, the returns were so high that they made up for the entire holding period. So equities are a very simple asset class. They may give you excess returns ahead of earnings growth. In some periods, they may give you returns below earnings growth for some periods. But in the end, both tend to converge. So I think the returns, nil returns of last 1 year, the reasons were pretty simple, and I think it was discussed 1 year back also. Post COVID, there's a lot of, from a very low base, the returns were extremely high, and a lot of excitement was created, a lot of positivity was there, a lot of new investors joined. And in that momentum, because of this large flow of money, the markets probably overshot the fair value levels. And that is what is the primary reason to my mind of this 1 year of time correction. I think there was one more issue here, and that was around earnings. The corporate profitability in India was extremely low. Large banks were under stress, capex was weak, commodity prices were low. From that very low base, the growth in earnings was much higher than nominal GDP growth rates as margins normalized. And I think to some extent, there was an extrapolation of the trend, and the expectation 1 year back was that the earnings growth will be around 15 odd percent. I think those earnings expectations were aggressive because margins cannot keep on expanding indefinitely. And therefore, with the real earnings growth of last 2 years, last year and the current year, half year, I think earnings expectations have also been reset. I think that probably led to some disappointment, especially with the foreigners, because they are willing to pay a much higher valuations of India versus EMs, provided you have those earnings growth to back up. But as earnings growth slowed down, I think they felt that those Indian markets should trade lower or they had better opportunities in other markets. And that's why we have seen persistent selling by or on and off selling by foreigners. Now, where are we today? I think with this 1 year of time correction, India has underperformed EMs by 20 odd percent. We have underperformed China by even a higher margin. And today, the premium of India over other EMs has come down to average or near average levels. The earnings growth expectations are also far more realistic today. So I think over time, these markets should do well. What we have also observed in the past, in that markets, when they consolidate around one level for 1 year, 18 months, etc., typically the next move is on the way up, not on the way down, because earnings have grown in that period. And market in this last 1 year has withstood and held its ground on FI selling on more than one occasion. So I feel the markets over time should move higher. However, I you mentioned one point of 15% earnings growth. I think India's real growth will be maintained. It may actually move a bit higher also. We should continue to grow between 6 and 7% in real terms. But clearly, inflation in India is a lot lower today than what it used to be in the past. And therefore, the growth of economy in nominal GDP terms, and therefore the growth of top line of companies is around 10-11% in aggregate terms. So I would not expect Nifty to compound around 15% over the next 3, 5, 10 years. My guess would be it should compound somewhere closer to 11, 12%. Yes.
Understood. So I will come to that. You spoke about how margins have surprised on the downside, which has led to EPS not keeping up with estimates. I want to take a cue from that and try and understand as to where you see it today. Do you expect margins to sustain at current levels, or do you still see some bit of possibility of margin erosion happening? Give us that sense, sir.
So Harsh, I think margins have fully recovered in last 5 years. Margins hit a very low level around COVID for a variety of reasons. And since then, the recovery has been extremely strong. I would by and large expect the current margin levels to remain flat or very, very range bound over the next few years. But that means your profit growth will slow down because if margins remain flat, then profits will grow essentially in line with the growth of the top line and aggregate terms, which is around 11, 12%.
And sir, you've been and talking a little bit about behavior here. You've had long periods of time where you've had to be very composed with regard to the bets you've made. And right off the bat, I can think of two bets that you've had to play over the last 10 years maybe. One was the PSU theme, which you played beautifully. You took all of the pain and yet you continue to play it. And the second theme is, which off late you started being bullish on, is the private sector banks. So just from a behavior perspective, what is it that keeps you composed despite a possible underperformance that is playing out? You just focus in on earnings and say, as long as earnings is doing fine, we're okay. Is that how you think? Give us that sense.
I think, Harsh, this is key to equities. I think if you the key to equity is good investing to my mind first is to have a good understanding of what you are buying. And so many of us, we simply focus more on momentum as a decision criteria than the understanding of the underlying business. What are the likely growth rates and what are we paying for it? So I think I have always invested based on, I would believe, a reasonable understanding of the underlying businesses, had a reasonable sense of what likely growth could be, and have refrained from overpaying for that growth. And I have seen time and again, not just last cycle, but even over previous multiple cycles, that if your understanding is right, if business continues to grow, and if you have not overpaid, it is only a matter of time before the price reflects the underlying fundamentals. On the other hand, if you invest based on momentum and you overpay or you overestimate growth rates, the long-term returns will be very disappointing. And that again has been experienced multiple times. So I think, I mean, this is the way I invest, this is what I am capable of, and I play to my strengths. And I don't see any other reason how a person like me can add value. So, except being patient. And when I bought into the PSUs, I think we were careful by and large to buy the stronger companies. They were, in some cases, there was pressure on profitability, but that was temporary. The underlying intrinsic value of the businesses were growing. And when do you buy great businesses cheap? When the near term is in pain. So confidence to hold them for the long periods comes essentially from the understanding of the business. What are the drivers of profitability? What are the drivers of growth? And if they're intact, then you are able to handle the pain of price underperformance for some time. We must distinguish between size and speed. So India indeed has a very large TAM. India is the world's fourth largest economy, soon to become the third largest economy. It's a 4 trillion economy going to 5 trillion in few years. So it's a very large economy. It is also a fast growing economy. It is of the top 10 economies, it is probably growing the fastest. And what makes it the fastest growing economy is a 6 to 7% real growth of the economy. Now, what is top line? It is real growth, volume growth plus inflation. So we are celebrating low inflation. Government, RBI, everyone has done a lot of work over last few decades to bring inflation down sustainably. And it is a extremely good development. But that also means that if you measure your growth in local currency terms, your growth rates will be commensurately lower than when inflation was 9%. So today, 6 7% real growth, 4% odd inflation, that takes you to about 11 odd percent. As I discussed earlier, margins, to my mind, in most of the large sectors have very limited room to move up. How have you brought inflation down? You have brought inflation down by opening up, by reforming the supply side, by freeing up imports, by improving your logistics, your infrastructure. E-commerce is leading to better price discovery. So competitive forces are increasing in virtually every industry, which is great for competitiveness of businesses, which is great for consumers. But the flip side of that is it will lead to lower growth in rupee terms. So I think 11, 12% is the way to go. At the same time, it should, India's hopefully the depreciation of rupee in dollar terms against the dollar should be much lower because the gap between Indian and US inflation is sharply down. So if you look at last 30 years, India has been the best performing market along with US in the world, but the dollar returns were around 9-10%. So 15% was your local currency return and your rupee was depreciating maybe about 6 odd percent a year on an average. So your dollar returns were 9-10%. I think next 10 years it should be the same. So your nominal growth may be 12. If rupee depreciates 2-3%, you again come back to that 9-10% dollar growth. So I think it is optical. If you measure the wealth creation or the increase in purchasing power, there is no difference between the past and the future. But yes, in rupee terms, the wealth creation will be lower. You can also get a sense of this from when I bought my home, we were paying 12% on home loans. Today, you can get a home loan at 7.5 to 8%. So why have interest rates come down? Because inflation is down. So I think it is suggestive, low interest rates, low inflation, low rupee depreciation, low CAD, they are suggestive of very strong economic fundamentals. I think we just need to differentiate between real wealth creation or increasing purchasing power and rupee growth. So I don't think wealth creation will be adverse compared to the past.
Okay, so that's wonderful perspective. Thank you, sir. I want to also try and weigh in on some sectors which you have in the past somewhere suggested have been slightly overvalued of sorts, or there's been lesser margin of comfort. Let me tone down the language. There's been lesser margin of comfort on some of those sectors, and to a certain extent that's FMCG, but also there is some bit of pessimism with regard to growth in some of these segments, because there seems to be a growing concern that while the addressable market is large, there's a huge penetration of these products already existing in the current economy. Talk about IT, they've grown very, very large. Talk about FMCG, they've grown very, very large. Do you believe that some of these sectors will be sectors of the past, or do you expect them to continue to possibly play the rotational trade and come back into vogue in the next couple of years?
No, Harsh, I think it is a very fair comment that uh, growth rates are a function of the not just the addressable market, but of the penetration levels. And many consumer categories, especially in the staple space, are highly penetrated. And just because incomes grow, it does not mean you will use more staples. So the consumer discretionary products are likely to grow faster than the consumer staple products. And ditto for IT companies, they have gained share massively over last 30, 40 years. And I think their growth rates are now by and large converging with the market growth of IT services. I think the expectation is that these two sectors should grow anywhere between 5, 6 to 7, 8%. Now, there are two more things here we need to take note of. One, both these sectors don't need capital to grow. So the payout ratios in many of these companies in these two sectors are extremely healthy. So you need to add back the dividends when you assess these investments. And uh, I wanted to mention one more thing. Yes, it is the multiple. See, there is a price to be paid for different levels of growth. If a business is growing faster, you will pay a higher P and vice versa. So off and on, you will find that growth gets mispriced, and even slower growing sectors can become much cheaper than the fair levels. And even when that happens, if you participate in them, apart from earnings growth, apart from dividend yields, you can once in a while hope to make some money on multiples going up, multiples re-rating also. And that applies in reverse to overvalued sectors as well. So currently, I feel, I mean, the multiples on the consumer staple space could have some more room for downside. I think in IT services, I personally feel that by and large, the valuations are at reasonable levels.
Fabulous, sir. So how are you playing the consumption theme then? There's just everyone's talking consumption at this point. How do you play that?
So I don't think, there can be a very appropriate answer to that, probably without going into individual stocks. So I think we are preferring consumer discretionary businesses more than the consumer staples businesses. But by and large, I must say that the consumer consumption theme in India is pretty expensive. See, whenever you enter a phase of narrative-based investing, there that narrative, it tends to become expensive. It happened to the defense companies, it happened to capital goods companies. 5 years back, it happened to chemical companies. And I think consumer also has been a dominant theme, a narrative driven story. And that's why we are seeing some underperformance in that space.
So there was plenty of chatter, maybe 12 odd months ago, with regard to the small and mid cap space in general being overvalued. I know, sir, you're a bottom up investor at your very core, but talk to us about how valuations are currently looking. We've seen a flatlining in terms of the index. In fact, so mid and the small cap has actually corrected. Talk to us about how much of that correction is done, because uh, when I think of valuations, you are one of the first people I can think of in terms of understanding prudence in the market. So give us your sense.
So, Harsh, I think I have said it repeatedly that small mid caps are very expensive, and I would clearly prefer large caps in this at this point of time. So in small mid caps, it is a wrong notion. As a category, I don't think they outperform large caps over long periods. But yes, post COVID, the small mid caps have delivered high returns. And the simple reason for that is that in the COVID fall, if large caps fell 30%, small mid caps fell 40, 50, 60%. And because of the much lower base, the returns have been much higher, but I don't think that can be sustained. And bulk of the new stock supply is also in the small mid cap space. It is not in the large cap space. So I think over time, large caps, to my mind, should outperform small and mid caps.
Afternoon, you're watching Closing Trades, and we're coming to you live from the SBI Live ET Now studios. Just taking stock of the market, and that volatility continues within, of course, a very narrow band. The Nifty has been struggling to stay afloat, and once again breaking into the green, about 72 points higher. 25,129 is where we're currently at. In the meantime, let's just take stock of what has been buzzing in the markets, and let's just bring up the list of movers so far. While, of course, Wipro is doing good, there's TechM, there's also some of those healthcare names like a Max Healthcare, Apollo Hospitals, which are also holding out well. And it's interesting to see that even Infosys ahead of its numbers, HCL Technologies, they are the ones which are holding out in trade. But lots in the green, or rather in the red, I should say. Bajaj Finance, that's down 2%. TCS is down 1.5%. Tata Steel is under pressure, along with the JSW Steel as well as Hindalco. There's Axis, Trent, Asian Paints. A large chunk of the market is reeling in the red. In fact, even if you look at the breadth of the market, it's a count of 167 which is standing to the reds within the F&O pool, with just about 47 names standing to the green. So it's the broader market end wherein you are seeing more and more pressure, and a serious bout of profit taking today within the auto pack is what one is witnessing. Of course, don't be fooled by that 39% crack in Tata Motors. That's not how it's meant to be. That's only an adjustment because of the demerger. But Dixon, Idea, Bandhan Bank, Gale, these are some of the other names which are also down. Kunal, where do you see profit taking? I mean, I can spot only autos. Other than that, where else?
So I think very selectively, Aisha. It's not in terms of the main sectors, because realty making a comeback, IT stocks making a comeback, private banks, Bank Nifty looking quite strong. In fact, we've seen a very good recovery on the intraday charts also for the banking index, where we've recovered from 56,000 to 5300 levels to now back again close to 56,500 mark. So I think it's very selective towards few of individual names, but nothing major in terms of price trends which you're spotting out. Yes, few of these NBFC names, Bajaj Finance, etc., is coming into a selling or minus selling pressure. But I think it could be just about some adjustments which could be happening because of the run-up these stocks have gone through, and maybe some bit of cool off the indices have been seeing at higher levels. But no major trend as such on the downside.
Okay, a good earning boost for IREDA, and that stock is holding up 3.5%. We'll try and get one of our researchers to analyze those numbers as well. But a good spurt after the earnings came by, and it's managed to hold through onto the gains, about 3.5% higher for IREDA as we speak. Other than that, of course, it's really tech all the way, or IT, I should say. That's one trend which is looking good. Sona Comstar, a really beaten down name, that's propped up about 4%. MCX is, of course, holding higher by 4.5%. And today you've got a 361, which is also looking good by about almost 2% or so. But Harsh, I guess the big boys are going to be over the weekend when ICICI Bank and HDFC Bank deliver their numbers. What's the anticipation from there?
Yeah, I mean, you'll see more of the same. In fact, when I'm looking at Q1 versus Q2, you'll see a little bit more of the same, but more tempered, in the sense that your margin declines that you will likely see will be far, far lesser, hopefully. You've seen good growth coming in from an HDFC, so the anticipation will be that growth will continue to surprise even for the likes of an ICICI on the upside. And you will see some bit of compression on the ROA, because the one key factor which is holding across all of the preview notes that we are looking at is your treasury income may fall versus Q1 FY26, and that may have an impact on profitability, because that's been the real support where ROA is concerned. So you might see a taper down on that count. But of course, outside of that, you are expected to see no concerns with regard to credit costs. There isn't anticipated to be any major one-offs either. So you'll see a stable quarter, but the key factor will be on the commentary side of things. And on commentary, it seems that you will start to possibly hear whether loan growth has picked up or not. So that's the one key factor. And how much can margins recover in H2 will be the other key factor, which at least I'll be looking out for from the commentary.
Yeah, and Friday, although post-market hours, you've got the big one, that's Reliance Industries as well. But Kunal, purely within the private banking names, ICICI Bank, HDFC Bank in particular, given the kind of churn that's happened within banks, how do you think these stocks are positioned going into their earnings?
So they are raring to go, I would say, Aisha, because these stocks have underperformed. But when you see such kind of a strength emerging into the sector, you hardly see a point where, or rather rarely see a point where the larger cap private sector banking names underperform for a significant period of time. My expectation is that both of these stocks are just about gearing up or ready for a breakout on the upside. Whether it happens immediately pre-results, post-results, that's difficult to anticipate. But I think from here on, the risk reward is extremely favorable, because we've already seen the likes of Kotak, Axis Bank, and of course the PSU banking lot, which we've been discussing earlier, that these stocks have done phenomenally well for themselves. Private sector banking stocks like ICICI and HDFC Bank, they've tried to show signs of at least strength. The sell-off has abated for these stocks. There has been some stability which has come back into the stock prices. It's not translated into the stock on the upside, but if the bank Nifty continues to show signs of strength, eventually you will see these large cap private sector banking stocks break out for themselves and help the bank Nifty move up to a higher level. So I strongly believe that it's a good trading zone to bet on the likes of HDFC Bank and ICICI Bank.
Okay, that's the take on how ICICI Bank and HDFC Bank are positioned ahead of their earnings this weekend. We'll take a very quick break on that note, but come right back. We'll continue tracking markets on the other side.
Welcome back. You are watching ET Now, and we are live from the SBI Live studio, coming straight to you with regard to closing trades. Now, let's quickly pull out one stock which is doing well, at least on the insurance side of things. There is an ICICI Pru Life. The numbers came out, not half bad, frankly, but there was no growth. The growth was what was absent in those numbers. Very, very low single-digit growth, both on the VNB, which is value of new business, as well as AP, which is annualized premium equivalent. Both of those not showing any signs of revival, but the only possible positive is margins have gotten slightly better off a very, very low base. So that's the one key positive. Stock is perked up 1% or so in trade. Kunal, anything within insurance that catches your eye? Because you'll have a host of insurance companies come out with numbers between today and maybe end of this week. Maybe not all, but a host of them. Anything that catches your eye?
Frankly speaking, nothing.
Nothing, yeah.
I think this has been one space which has clearly underperformed. HDFC Life has been an underperformer. I think except for a phase for SBI Life, the stock has also been more or less in an underperforming or maybe a sideways zone. LIC of India, I think post the listing also, I think the stock has gone through correction. So no major trends emerging on these insurance name, even on the short-term charts. I think if I'm not wrong, intraday, there was a point where ICICI Pru was up a couple of percentage points, but then even that stock has sold into. So very difficult to anticipate any major trends over here.
Okay, difficult to actually spot trends when it comes to insurance, but it's the hospitals which have been doing well. In fact, I think, Kunal, that's been one of the best trades this year, right?
Yeah, Fortis Healthcare, I think Max Healthcare, Apollo Hospital.
All of them.
I think these stocks have done phenomenally well. And it just looks like that the segment is moving into a different space altogether, devoid of how the markets have been moving, or just about money being focused specifically on these kind of stocks.
Okay, that's that. And most of those stocks are already sitting at their life highs. Other than that, of course, what's also been, sort of holding out today, of course, is IT. But Kunal, does it seem like today could be a meaningful move? I know we've been talking about it, whether this is a conclusive base building for IT as a pack or not. Or does it seem like it's going to be one of those cases again, wherein you're going to sell on news each time a large cap IT services company comes out with its numbers?
No, I think it'll be very, very specific. So for example, HCL Tech, the charts were looking positive. You saw the stock moving up higher. TechM, I actually believe that the setup is looking a little bit more tepid. So maybe the stock can see some bit of underperformance. Infosys had a very good positioning in terms of the open interest, and the stock has moved up almost 100 points from the recent swing lows, or I think rather start of the October series for Infosys. So it's very, very fragmented, very, very specific towards the set of stocks. But yeah, I think what we are also seeing is that large cap stocks have started to dominate the trend for these IT names, and you're not too much dependent on the momentum from the mid cap IT stocks, which was the case over the last many years. So that's the only big change which has happened in the entire sector.
Okay, all right. So that's with regard to that. Let's go across. Anurag joining us on RBL Bank with acquisition reports trickling through. Anurag, what are you hearing?
RBL Bank has responded to media reports about the information that Emirates NBD, which is a UAE lender, they are in advanced talks with the private sector lender RBL Bank to buy an equity stake, to buy a controlling equity stake in the bank. Now, RBL Bank, in a filing to the exchanges, has said that it routinely explores opportunities, and such discussions do not merit disclosure. And this is under the regulation 30 of the listing regulations. And at the same time, it is denying the news which has been trickling out. And ET Now had earlier reported that RBL Bank is in advanced talks with Emirates NBD for Emirates NBD to buy a controlling equity stake in the private sector lender. Now the deal would go to the RBI once the announcement is out. That is what the sources are telling us. In May, Emirates NBD was given the permission by RBI to operate as a wholly owned subsidiary in India, and buying a controlling equity stake in RBL Bank now means that they are tapping into a retail bank with a large consumer presence across the country.
Kunal, do you have a view with regard to an RBL?
Yeah, I think it's looking very attractive on the charts now. Today the stock is down, I think from the day's high by a couple of percentage points. But I think the way the stock has approached this last 6 months of price uptrend has been fantastic. Every time the stock comes closer to its 50-day moving average, we've seen this, as a very strong buying opportunity for RBL Bank. Something similar happened in August, September when the stock had dragged down towards 245, 250 range, closer to the 50-day moving average. From there, the stock yet again managed to make a new fresh swing high. And now I think at 290-95 mark, the volumes have been perking up very well. So looks attractive as a setup. Buying on retracement could be a better strategy for RBL Bank.
Okay, that's that for RBL Bank. In the meantime, doing nothing really on the index, just about, flickering and putting up a tough fight out there to try and claw back into the green. A little bit of a failed attempt. Let's see. Still got some time to go before we wind up for the day. So let's welcome on board Anshul Sehgal. He's right here in the studios and find out what he's been doing in this market. Anshul, hi. Good to have you in the studios.
Thank you,
and the index has been doing nothing. What are you doing as an investor?
Actually, firstly, thanks for having me. Wish you all a very happy Diwali, so also your watchers. It's a very, this is a phase which value investors actually covet, which is that the markets are boring. No one has interest after nearly 2-3 years of great strength. The markets are flattish overall. And then if you go below the frontline index, you'll see there is substantial correction in the markets, which means that while expectations were running ahead of themselves, now with prices correcting, time correction playing out, actually you are seeing some amount of catch up on fundamentals. This is a time where really one should buckle up, have the courage and build a strong portfolio, buy into quality companies where over the next, say 3-4 years, you're going to make substantial returns. The most important sort of ingredient in that is that you've got to have belief in the Indian patience and second, belief in the Indian growth story. So I'm actually heartened by this consolidation. I think that this is healthy for the markets. Weak hands are going out. Stocks are coming to their rightful owners who have the patience. And over the next 3, 4, 5 years, there will be tremendous amounts of money to be made. So I'm actually rejoicing.
But the only thing is that, historically when such phases of lull have come by, it's not been such a well-discovered market as it is today. Sure, there is a lot of new paper as well hitting in the market, and, few get lucky with subscriptions like LG perhaps, who must be celebrating today. But where is it that you hunt for pockets of value in this market?
Aisha, the beauty of the markets is that the markets move in waves, as in business cycles move in waves. So while IT was doing exceptionally well in 2020, 2021, PSU banks were doing very badly. But then come 2022, IT sector really plateaued. In fact, if you recall, some of the new age IT companies which listed in 21 went down 60-70% in 22, right? But then if you looked at PSU banking space in that year, you would notice stocks were doubling, tripling, by the quarter. So that's the beauty of the markets, and it has always been like that. For that reason, there will be certain spaces which are very well discovered, but the market is taking a short-term perspective on those. And if you look beyond the short-term weakness, you'll find tremendous opportunity. Take, for instance, say value retail. Value retail is a space, while in retail one hears of trend and how well that stock has done over the years. But then if you just trickle down, look at some value retail companies, they've really done nothing for the last 4 or 5 years. Now, if we believe rural incomes are coming back, if we believe GST is going to work and there is going to be a consumption boom in this country, then that space looks quite interesting, as also the footwear space. I mean, some of the frontline stocks in that space have been flat for the last 6 years. And others are down 60-70% from peak levels. Again, consumption comes in, those pockets start doing well. So there is definite opportunity, and that opportunity is because of the psyche of the market, which in phases becomes bearish and starts becoming myopic. If you can look beyond the next 1 quarter, 2 quarters, there is tremendous money to be made, and to play on behavior of the markets.
Okay, Anshul, hold on to that thought. We'll dig deeper on where is it that you can play on that behavioral science. But for now, we're going to take a very quick break. Come right back.
Okay, welcome back. You're watching Closing Trades, and we're in conversation with Anshul Sehgal. Anshul, so you were talking to us about the rural play, especially value retail. Some of those value retail players now, they're obviously guiding for very, very robust profitability, but they're sitting at probably triple-digit earnings multiples, if I can call it that, or close to that point. That a concern, that a risk, maybe from an execution standpoint?
Definitely. I mean, for those companies which are trading at such high valuations, clearly one has to be cautious. But then there are, I mean, of course, as I said, this is a stock picker's market, and you've got to really dig deep to figure out which are the pockets where valuations and growth don't match up. That growth is going to be strong while valuations don't reflect that. And clearly there are pockets which offer you that sort of a trade-off. These are relatively smaller companies. The bigger companies have been re-rated. The relatively smaller companies, I mean, if you can call 650 retail outlets in the country small, then somewhere around that, those companies which are available cheap. So there is definitely opportunity here.
And if I can quiz you more on something more macro, earnings cycle and capex cycle, both of these are long awaited. You see that play out maybe over the next 6 to 12 months?
Actually, if you rewind 4 quarters and you see earnings growth was quite robust. But then multiples went up even faster.
Yes.
And so earnings growth needed to catch up or to sort of remain at those levels for valuations to be justified.
Sure.
But since the election phase, earnings have tapered off. We were expected to do somewhere close to 12 to 15% growth. Now the expectation is, say, 7-8% growth on the index level, I'm saying. That does not justify the valuations. Now with all the measures that are being put in place, it looks like going forward, earnings should pick up. And even on the macros, we think that most of the weakness is now behind. On the capex front, private capex is just at the anvil of taking off. And we are quite confident both capex as also earnings, say in the next 6-8 months, will show a very different picture.
So other than the retail space, where else should one be hunting?
Aisha, I was in Delhi meeting some companies recently, last month that is, and I met with some companies in the renewable energy space. Now, one of the companies I met is a company in the EPC of solar, right? It does that business. Their commentary was, and they had their AGM just after I met them. In the AGM, their commentary was that this year we will double our revenues. On that base, next year we'll double our revenues. So you can imagine the sort of tailwind that one is seeing in that space, right? Energy is just, the requirement for energy is just going through the roof. So renewable energy is one space I think is going to do exceptionally well going forward. And there are going to be new iterations in renewable energy. We've seen solar, we've seen wind. We will, as we move ahead, see green hydrogen. We will see methanol and various other sort of aspects of renewable play out. Defense. The need to indigenize defense is so substantial, and our play into this theme is so nascent that the opportunity is, mammoth. And of course, in the short term, much of the growth expectations are built into prices. But then if you have a 5, 7, 10-year time horizon, there is tremendous money to be made in that space as well. And then there are, of course, the regular plays, banking and finance. I think that space has consolidated for a really long period of time. That looks interesting. NBFCs, those look interesting. Capital goods, I think the capex cycle in this country is really going to be robust in the next few years. EMS space, again, huge growth. And consumer durables, again, that pocket has been weak. We saw the new listing today, how that played out. That market is expected to grow for 5 years from now at double digit, the market itself at double digits. So individual stock opportunities in that will offer a lot of opportunity. So I'm actually quite excited. I'm quite bullish. I think that there is, of course, there will be short phases where things will be weak. But when one speaks with companies, the body language doesn't suggest that they're in any way defensive. The body language suggests that they're quite optimistic about the future. And if we just look at the stars around us, the macro, how India is positioned geopolitically, etc., I think that we are in a good place, and very little reason to be extra bearish. Just tide over the short term, things are going to be very good.
Okay, and where, Anshul, will the earnings re-rating be the strongest? Because those will likely move the quickest. So I know you've given us a great view 3-5 years, but where are the easy pockets of opportunity between now and end of the financial year is what I'm trying to judge. So where exactly do you believe earnings re-rating will be the quickest, which will likely unwind maybe in the next 2 to 3 months on stock price?
I think consumer discretionary is one space where the weakness has been the maximum. Look at some of the paints companies, for instance. I mean, those are down 60-70% from peak. Much of the sort of weakness is because of a new competitor who's come into the space, but also there has been a weakness in the macro, sub-macro of that space. People have not been painting too much. So I think that with this sort of a correction and expectations being down, that is a space, consumer discretionary in general, paints in particular, which hold promise and where one can have interest. Even consumer durables, homeware, those kinds of opportunities, as I mentioned, footwear, clothing, all of those have really gone nowhere in the last 3, 4, 5 years, while the markets were shooting the roof. So I think that that is one space where you will see the biggest re-rating in our judgment in the next 6 to 12 months.
When you say paints, still stick by with the leader, which of course did get threatened, and which is why I guess that massive underperformance in this stock. But do you buy that again?
If you're a risk-averse investor and you want low volatility, clearly that is the name to buy. I was recently at a conference, the PPFAS conference. I made a presentation there and I spoke about cycles, how cycles play out. And if you can pick out the right cycle, everything moves. But that cycle, if you can, if you can identify it, it can be very lucrative. We saw that in the PSU bank space, we saw it in defense, we saw it in railways, we saw it in PSUs in general, and we saw the reverse cycle play out in paints. When that cycle reverses, it's only a question of when, not if, right? When it reverses, everything will move. If you're risk averse, stick with the larger one. That will also do well. But if you want the greatest delta, then go with the smaller ones, because that's where illiquidity hurts them on the downside, and the same thing benefits them on the upside.
And what about some of the export-facing sectors? We've not spoken. You've spoken so much domestic. Talk to us about IT, pharma, textiles, maybe. These near-term risks with regard to tariffs. If those were to unwind, could you well see a largish re-rating on some of those sectors?
That's a very interesting question, and I think that that is a question that one grapples with on a daily basis, given the times, right?
Sure.
So let's put it in perspective. The tariffs have been raised to 50%.
Yes.
As a result, most companies which were supplying to the US have been hit meaningfully. Some of the textile companies, as also other players, have been hit quite meaningfully. Now, the worst case seems to be in. Right? If things become any better from here as the tariff negotiations proceed, there can be only positive surprises. And in many of these cases, the positive surprise can be material, because the idea before this implication of this tariff was that India is going to be better than the rest of the world, which didn't play out. But if it comes to that, then really the benefit on many of these sectors is going to be substantial. Pharma, I don't see a reason why one should be, not long-term positive. Of course, short-term and here and there will be issues on exports. That's, of course, a possibility. But the CDMO space in pharma can just explode. In CDMO, we are only 4% of the global market. China is about 50%. Now, assume that 3-4% of China's market moves towards India. We have a doubling in our market size, and see what that will do micro for the companies. And we have the capabilities, we have scale, we have knowledge, we have efficiency, everything over there. CDMO is a very positive space. In tech, I'm not extra bullish at this time. I think that valuations are still stretched for the headwinds that that space is likely to see, both in terms of AI as also the demand environment. I'm not extra bullish on that space at the moment. Textiles, binary event. If the tariffs do come down, they'll just shoot through the roof. So that's how I'm looking at it, case by case basis, opportunity by opportunity basis, and then take a call.
Would that be the case with the overall market as well? A resolution between India and US, and we will finally snap out of the range?
So again, on the macro, tariffs are one aspect. The other aspect is what was spoken of always in the context of India in the past, which is budget deficit, current account deficit, inflation, and all of those things. On that aspect, India couldn't have been in a better position as we sit here today. On the tariffs, there is a headwind clearly, and we are facing that headwind, which is impacting flows into the country as also the general mood of investing in equities. As I said, on that aspect, we've hit rock bottom. There have been murmurs of reconciliation at the top. The trade teams are likely to meet. So the possibility of things getting worse is much lower than possibility of things getting better. And I would play it accordingly. So if that does happen, India's in a very sweet spot. Flows start coming in, mood changes. Those sectors which are hurting start getting benefited. So I'd not be so negative at the moment on that count.
Okay, on that very positive note, thank you, Anshul, for your time today.
Thank you, Aisha. My pleasure.
Happy Diwali in advance.
Thank you so much. Wish you and your viewers also a very happy Diwali. Thank you very much for having me.
Thanks, Anshul.
Thanks.
Okay, well, we were just talking about paints, JSW and Pax AkzoNobel, right? That's what the announcement is. I missed that one.
Well, yes, AkzoNobel as well. Open offer for acquisition of around 1.2 crores shares, 26% equity from JSW Paints. All right, MTAR Tech is the other big one, and that one is absolutely on fire after $5 billion deal that it has won with a US client. Kanishka joins in with the details of that deal.
That's right. So MTAR Tech is in focus today. In fact, it's on a roll. The stock has surged more than 12.5% today, hitting a fresh 52-week high and marking its biggest single-day gain since February 2025. Now, let's take a look at what's driving this rally. While there is no specific news flow as far as MTAR Tech is concerned, but it could likely be linked to a $5 billion strategic partnership that has been announced between Brookfield and Bloom Energy. Now, Bloom Energy, that happens to be a key US client of MTAR Tech, it will become the preferred on-site power provider for Brookfield's global AI factories under this deal. Now, this partnership kicks off the first phase of a joint AI infrastructure vision, especially at a time when AI data center, they are powering the demand in the US, and that's projected to exceed 100 gigawatts by 2035. Now, Bloom Energy, it already supplies clean fuel cell technology to major players like AEP, Equinix, and Oracle. Now, with this new expansion on the cards, that is the $5 billion deal that has been $5 billion deal that has been announced, opportunities could emerge for the likes of MTAR Tech, which manufacture key components for Bloom Energy systems, and hence the stock is on fire today. MTAR Tech, no specific news flow as far as MTAR Tech is concerned, but its key client that has won a major deal, and that could possibly be the reason why the stock is rallying today.
Okay, thank you so much for that, Kanishka. So, MTAR Tech, on the back of a client winning a large order, is up and away in trade. Stand corrected there. Kunal, view with regard to an MTAR Tech and some of the other defense names?
Yeah, so I think MTAR Tech is over the last 2 months has been doing exceptionally well, and for the last 12 months or maybe more than that, the stock was a huge underperformer. And there was a point where MTAR Tech was one of the sole underperformers from the entire defense pack, and I think from 2,800 or 3,000 levels, the stock had fallen down to 50% and more. So it's recovering quite well. It's showing that in the last 2 months that whatever happened to the stock prior to that was more of an just about a price correction, and now the resurrection of the rally is coming back again into the stock price. That I believe is a positive sign. You've seen the core defense names or the most stronger ones, BEL etc., being also dominant in terms of the price trends. BEML, which I also believe is heading towards a breakout of sorts about the 4,300, 4,400 range. So these are the few odd names on the defense pack which I'd be keen into.
Okay, that's that on defense right now. And yes, BEL, in fact, has been one of the key performers of, I think, the year gone by. Actually, Kunal, given that there's been so much rotation, what have been some of the standout performers from last Diwali to now? Or even year to date, for that matter.
So I think L&T Finance was one of the stocks which we discussed, and I don't remember the list offhand, but yeah, I think
we should cull out, right?
Yeah,
It would be an
so.
interesting giveaway.
It's a very interesting.
You work on that then. Okay, HDFC Live then, and that's set to report its numbers. The VNB margins are likely to moderate. Let me take it across to Varun, in fact, and get in more updates on what exactly is the street penciling in.
HDFC Life is expected to report 8% growth in APE on YOY basis, when VNB is estimated to grow at 3% on YOY basis, while VNB margin is expected to be moderate to 23.2%, down by 110 basis point due to change in product mix. On the last call, management said that they expect 2H FY26 to outpace H1, and for full year, FY26 growth is likely to be lower than the FY25. And the non-product par mix is projected to rise in mid-20% range, whereas par product may decline to 25% during the year. Now, what we need to watch out for: investor may likely to focus on AP growth, margin trajectory, product mix, and channel performance. And alongside, management commentary on the impact of the GST reduction to nil on individual life insurance products, and its implication on growth momentum and profitability in coming quarters.
All Right, thank you so much for that, Varun. That's on HDFC Life to kick off life insurance earnings. ICICI Pru, by the way, came out with earnings today. So the HDFC Life will also give direction as to how life insurance numbers are coming through. Tata Motors, long-awaited demerger takes effect today, splitting its passenger vehicle and commercial vehicle businesses into separate entities. The CV unit will list in 30 to 45 days. The move aims to unlock value and give each business sharper strategic focus. Srishti explains what happens to Tata Motors post-listing.
Well, yes, Tata Motors, finally the demerger is through, and the stock that is trading right now is the passenger vehicle entity, which includes the India PV business, EV business, as well as the JLR division. And in the price discovery mechanism and the special session that was arranged, it was found that PV business has actually got a value of 400 rupees. It got listed at that, and along with that, the CV business, if we compare it with yesterday's closing price, that was valued at around 260 odd rupees in the price discovery mechanism. Both the prices were actually in line to the market expectation, because PV business bang on at 400 rupees is something that consensus analysts were expecting for, while for CV the price target, or rather the valuation, is close to 280 to 333 rupees. But that is something that we will be watching out for, because in the next 30 to 45 days the CV entity will get listed on the stock exchanges. For now, it's not Nifty 50, it's going to be Nifty 51, because the CV business will be there, but it will be a dormant share in the portfolio. It can't be traded right now, but definitely a lot of adjustments from this passive fund segment will take place. So definitely a big announcement and a day for Tata Motors.
Okay, that's Darren Tata Motors. In the meantime, Roche has moved the Supreme Court against a High Court order for the launch of one of its key drugs. And that stock will just come up for you on your screens next. But yes, Dixon, Idea, Bandhan Bank, Gale, that's where you're seeing the meaningful losers. Natco Pharma currently lower by about 3.5%. If I'm not mistaken, Natco did have a very positive news as well not too long ago, which is when the stock did jump up. We'll try and get in more details on that. But that said, just looking at the texture of the winners today, while IT, of course, is managing to, be quite resilient today, led by names like Wipro, which are holding out. There's TechM, of course, which is also looking smart. Look at MCX, that's shot up a good 4.6%. Sona Comstar has moved about almost 4%. And then IREDA has reacted smartly to its numbers, 3.5% higher. And Harsh, you were taking a look at those numbers, right? IREDA, good performance there, at least just operational numbers that we have.
It is. It frankly is a good performance, and I'll just quickly pull it up. The growth, of course, was strong, and that came in a few weeks, or rather a couple of weeks back exactly. And the net interest income this time around has gone up 41% on a YOY basis. So very, very strong NII growth. And that's also led by the net interest margins expanding from 3.6%. Your net interest margin has now landed up at 3.72%. So that expansion has been sharp. Your yields haven't particularly gone up, but your cost of funds have come down sharply. 16 basis points fall in the cost of funds, and that's what's aiding the net interest margin higher. Operating profit as a result of that quite elevated, 54% YOY, 15% QOQ. Mind you, in terms of operating costs per se, the company does chunky lending, so it enjoys operational efficiency on its P&L, which is exactly what's playing out. And then you have provisioning, which has come off on a sequential basis. Last quarter, there was one large account which slipped, and this quarter that has reversed, and you've seen 70 crore of provisioning which has happened, which has also supported the profit after tax, which is up 41% on a YOY basis. Gross and net NPAs come off from those highs because of the provisioning done in the last quarter. The gross and net NPAs have now come off, and your outstanding loan book has gone up 6% QOQ, 31% YOY. So impressive set of numbers overall. It's another quarter where it's a bit of a comeback. After Q1, which was slightly weaker, we've seen Q2 where IREDA has made a very, very solid performance, or delivered a very, very solid performance on that count.
Yeah, and one of the most sought after names after its IPO, and then of course it went into a complete lull. I mean, almost it reminds you of the the frenzy that you're seeing today around LG. In fact, we should, bring up that one, because irrespective of what's happening in the market, LG has managed to stay put with its listing gains, and I think it's still going home with a near about 45 to 50% gain to its issue price, and its listing has been one of the most phenomenal ones that we've seen in the recent past. Not the peer comparison, if we could just bring up the intraday graph for LG. But that said, let's begin winding up for the day as well. And I'm going to hand it over to Snehi actually for that.
Well, yes, let's take a look at how the markets have panned out in today's trade. It was completely volatile in the sense that there were points where it was difficult to hold above the 25,100 level. We had slipped below that. But right now, we're doing pretty okay, up above the 25,100 level on the Nifty, a 0.4% cut. So that cut has slightly intensified, and same cut coming in for Sensex as well, 0.4% lower, and 81,977, so below that 82,000 mark on the Sensex, a 350-point cut intraday basis coming in on the Sensex as well. The advanced decline ratio, no doubt, in the favor of the declines today quite steeply. I want to pull up the India VIX and see what the India VIX was up to, because after quite some time we've seen a spike up coming in the India VIX today, up about 4%. Well, that's simmered down, okay, a 3% uptick coming in on India VIX, but above that 11 mark. The broader end of the market too was rather tepid and underperformed the benchmarks. You had about 0.8% cut coming in on the mid cap space, about more than 1% cut coming in on the small cap space. So weakness in the broader end of the market. Still, despite that, you have names like Wipro, Tech Mahindra, Apollo Hospitals, Power Grid, Shriram Finance, Bajaj Auto that did well from the Nifty pack. These were your top gainers. Tech Mahindra and Focus ahead of its earnings. On the flip side, pressure on the Nifty from Dr. Reddy's, BEL, Bajaj Finance, TCS and Trend. These were some of the top losers, all of them seeing cuts of anywhere more than 1%. If you take a look at the sectoral gainers and losers, no gainers today. All the indexes have closed in the red, with Nifty Financial Services, banks, auto, IT, FMCG. These were leading the cuts. This was followed by energy, pharma, realty, media, metal, and PSU banks was the top loser. In fact, PSU banks lower by 1.5%. So it's names like Canara Bank, Bank of Baroda, PNB, IndusInd Bank that have been some of the big losers from the entire banking space. But from the PSU banking space, Maharashtra Bank on the back of its earnings was lower by about 4%. IOB, UCO Bank, Central Bank, all of these were lower. So that's the breadth of the market. But on the flip side, there were some outliers today. CE Infosystems continued its strong run for the second day, up about 11.5%. Anand Rathi Wealth on good earnings, up about 8%. You had MCX that was doing well, as was the case with an Ireda, like Harsh was just talking about, decent set of numbers coming in. So these were some of the outliers in the market today. But all in all, if you have to wrap up today's action, it's been quite a tempered day for our markets. A 4.4% cut is what we've seen on the Nifty. It looks like we've closed above 25,100. We'll give that rate some time to settle. But with that, we'll wind up on this edition of Closing Trades. Thanks so much for tuning in.